Hi, all. Welcome and thank you for joining us for our Q4 2023 Investor Livestream. I'm Bart Deal, the Director of Investor Relations, and I'm joined here today with our founders, Jameson Manwaring and John Kabrowski. We'll be holding a Q&A at the end of the presentation, so if at any point you have any questions, feel free to type them at the bottom of your screen. You can submit them, and at the end of the presentation, we will answer all your questions. In considering the performance information discussed today, prospective investors should bear in mind that past performance is no guarantee of future results and that there could be no assurance that projects will achieve projected results. In addition, actual future conditions may require actions that differ from those contemplated at this time, and prospective investors are cautioned not to place undue reliance on these projections. This presentation includes certain non-GAAP financial measures. Certain statements such as believes, anticipates, plans, intends, expects, target, preferred, and words of similar import constitute forward-looking statements. Such forward-looking statements involve known and unknown risk, uncertainties, and other factors that may cause actual results, performance, or achievements to be materially different from any future results, performance, or achievements expressed or implied by such forward-looking statements. All right, some quick announcements before we get started. Distributions are on the 10th of each month, and they will be shown in the cash available section on your dashboard. With the cash available option, you can click reinvest and you can take your funds and reinvest them into opportunities like NV REIT. Also, I'm excited to announce that we have a date for our investor holiday party. Friday, December 1st. We're looking forward to seeing you guys. This is a great opportunity for us to get to know you, for you to get to know us, enjoy some live music, some great food, and pick up your investor bottle of wine. And speaking of staying connected, I wanted to invite you guys to follow us on social media. We're on all the major channels: Instagram, Facebook, TikTok, LinkedIn, you name it. So whatever your preferred channel is, give us a follow. It's a great way to stay up to date on what's going on with the company, what's going on with offerings, and what we're doing internally. Last thing I want to touch on is Kiss My Assets. Kiss My Assets is a great podcast where we talk about trends going on in the multifamily market and all things real estate investing. My favorite segment is our investor stories. So if you guys would like to be on there where we can learn more about you, we can talk about your investment experience with us, please feel free to reach out to Oakley@neighborhood.ventures and we'll get you on an episode. And with that, I'll turn it over to Jameson.
Thank you, Bart. We're really looking forward to seeing everyone at our holiday party. It's going to be here at the Grid in Central Phoenix. Looking forward to seeing y'all here. We've had some great events over the past couple of months. Our Taco Tuesday event a few weeks ago was also here at the Grid. We saw some old investors who came back, some longtime investors, I should say. We also had a lot of prospective investors who came out to learn more about what we do, so it was a great time. We look forward to holding another Taco Tuesday soon. We also had our Route 66 open house up in Flagstaff. It was great to get out of the heat, go see the beautiful mountains and trees up in Flagstaff, and the property looks great. We appreciate all the investors who made the drive to come out and see it. The property turned out beautiful. We also have some great updates to our investor platform and dashboard. One really popular feature is our Auto Invest feature. This allows investors to invest a specific amount every month on the 15th of the month, with as little as $100 coming out each month. This is something you can set up on your platform, and especially for starting early investors, this is a great way to get invested in real estate. We have also updated what we call our personalized investment page. So for new investors who are looking to place an investment, you can see different options that are available to you based on your income and your net worth, or you can customize that amount if you want to choose a different amount. But this is a big upgrade to our platform, and we hope that you like it. So I want to talk a little bit about our open offerings. First off, NV REIT, which now has over 300 investors. NV REIT is open to investors nationally. Our first acquisition, Venture on Williams, occurred earlier this year in February. The REIT has also invested in Venture on 17th. The REIT is open for investing currently, and we distribute 5% annually on the 10th of every month. Venture on 36th Street is also open for funding. We have raised over $1.5 million on this project already, so we've already reached our target raise and we've purchased the property. but there's still a little bit remaining where we can fundraise before we reach our max. This project is open to Arizona investors or to accredited investors outside of Arizona. And now I want to turn over to John to tell us about the renovations happening at 36th Street.
So things are going well. 36th Street's been in renovation for over a month and a half now. We've got our first 10 units turned over to management. That means we've got them complete and they look nice. And we're probably ahead of schedule, I think, technically right now. Painted the exterior of the property, all new appliances, new kitchens, new bathrooms, new flooring. The pool area looks beautiful. We're working through the process of either moving existing residents into renovated units or finding alternative housing for them as we renovate the rest of the units. So let me talk about some of the trends in multifamily. If you've been watching the news and if you talk to anybody around you, nobody wants to sell or buy right now. Interest rates are high. Values are still high. They haven't come down at all. And the same thing in multifamily. So we're seeing very few transactions in the multifamily business. More importantly, banks are lending at terms that aren't really favorable, both in interest rate or the amount of loan they're giving you. So that will change because I don't think banks can exist at making money off of savings account fees forever. They have to lend money to make money. So as everybody knows, interest rates are high. Single family home rates right now are over 8%, and multifamily and commercial rates are over 7% and approaching 8%. That's not horrible historically, but that's 2 to 3 times what they were before. So if you have a loan on a property, people don't want to sell, and buyers are holding steady. So we're not concerned about interest rates because we've got low interest rate, long-term debt on most of our projects. And now we're focusing on operations to make our properties run better at a time that we have the time to do that. So our plan is to not sell and to look for new opportunities that are the right opportunities for us. So stabilization, we have 2 of the 4 properties I want to talk about that are stabilized right now. Broadway, which is our first and only retail project, is doing well. Burger Rush and Dunkin' Donuts are in place and they're operating well. We've been reviewing offers on the 3rd space. So far, we haven't found the tenant that we really want. As soon as we do, we'll lock that down and then we'll start doing our distributions once that tenant's in place and starting to pay rent. Route 66. For those who joined us at the open house, it was a beautiful day and the property looks fantastic. It's running really well as a short-term rental. And our plan is we're going to run this property through the winter because we want to understand the ebbs and flows of the short-term rental market in Flagstaff, build up some reserves. And then as we get through this first season and get into the spring, we can assess when to start paying distributions. But based on how well it's doing, that won't be very long ahead of us. Okay, and with that, I'll turn it over to Jameson to talk about the other properties.
So I want to begin with Venture on Central. Venture on Central is currently 94% occupied, but 100% leased. Current average rent is $1,866 per month. If you remember when we bought the property, the average rent was $1,000 per month. So we've seen a really nice increase. However, we did expect to see rents at higher levels when we purchased the property. One of the good things and also somewhat negative things is the property's kind of hidden away in this really nice neighborhood in Central Phoenix. So we don't get a lot of drive-by traffic. So we have to drive traffic to the property primarily online. The benefit there is once people move in, they don't want to leave. And that's what we're seeing. Our occupancy has been really strong. And we're in the process of taking rents to where the market rate is at $2,300 a month. So we expect to see rents continue to move up as they already are. And that by the end of next year, we will be around that $2,300 a month on average. And at that point, we can begin paying distributions.
Yeah. And I think to add to that, I think we've only had 1 tenant turnover on that property.
Yeah,
and we're actually coming up on our first set of renewals on that property.
Venture on 12th Place, occupancy is currently 83%. There are still 6 units that need to be rented. Initially, we filled several of those units, and the last couple months, we began to see a bit of a softness in the demand for apartments in this area. We've still seen a lot of traffic, but there's more options for tenants and potential tenants in that neighborhood currently. So our current average rent is $1,590 per month. If you remember, our previous average rent was $803 per month. So we've seen a really nice increase post-renovation. After we get these final units rented, we expect to begin distributions sometime next year. Venture on Eldon is performing well and is currently cash flowing, and we're paying distributions to the investors on the 10th of every month. Occupancy is at 83%, but we've been at 100% occupancy for the last several months. We had a few tenants that just moved out, and we expect to get those vacancies filled soon. Current average rent is $19.15 per month. Previous average rent before we purchased the property was $9.75 a month. So we've seen a really nice increase post renovations. We have a few properties that have not performed up to our expectations, and we will need to temporarily pause distributions on these projects. This is not something we're excited about. We know investors love getting distributions, and we love sending distributions out. But as managers of the project, John and I have looked at it, and we decided we needed to take action. We needed to pause distributions, and we're doing many other things, which we'll talk about. But this is part of managing the property, making sure that we have the right reserves in place so that the properties can function at their high performance.
And we noticed this happening a few months ago. Hindsight, we wish we would have moved quicker, but the reality is we were listening to our managers and some of the feedback we're getting, and we finally made a decision that no one can run these properties better than us because we have the best vested interest, and this is the right move to make. So it's already proving out to be the right thing to do.
First off, we're going to talk about Venture on Country Club, and I'll turn it over to John to update you on that.
So on Venture on Country Club, you'll remember a year ago, we submitted our application for the rezoning, but then pulled it back because of some factors outside of our control, and I think it was the right decision to make. We've resubmitted our zoning package this summer, and then we had our neighborhood meeting. We're now at the point where we have one last sign off from the city staff member, and has to do with how we retain our drainage water, our rainwater on the property. And as of last week, we've submitted our plan for how we're gonna amend that and attend to his questions. And we're hoping to have that answer back to that soon. Now we're moving into the transition period from the short-term rentals to a multifamily property, and we're gonna pause our distributions to build up some reserves to cover those costs during that time. We're gonna be slowing down our short-term rentals and stopping that at the same time that we're gonna be gearing up our long-term rentals, and there's gonna be some needs for operating capital, and this is the best thing to do. And to put it pretty simply, this would have been part of the plan no matter what. We had to have that transition period, and now we're doing it now. We expect that's going to take just a few quarters to go through the process of shutting down our short-term rentals, turning on our full-time rentals, and then putting on a new long-term loan on the property. And that's all part of that same process. Investors will continue to receive 12% return on their money, but distributions won't be distributed because we need that money to build up some reserves.
Yeah, and I think that that's important to understand is that as investors, you get a 12% preferred return. Some of that comes in cash flow every month. Some of it comes at the end when we liquidate the property, but your 12% doesn't change. So we've been distributing every month on Country Club for about 2 years now. So we're pausing that for a few quarters while we go through this transition. But while we're pausing it, you're still earning your 12%, and we'll catch up on that when we liquidate the property at the end. So let me move to the Neighborhood Ventures Fund, which is about 30 investors who invested in the fund. Venture on Country Club remains a large portion of the remaining capital that is left in the fund. And because we're pausing distributions on Venture on Country Club, we're also pausing distributions for the fund for a few quarters. As we go through the transition process on Venture on Country Club, and we complete that sometime next year, we also expect Venture on 12th and Venture on Central to begin distributions as well. And we expect Venture on Route 66 to begin distributions early next year. So there is a temporary pause on the fund distributions, but we expect that will change over the next couple of quarters. Let me move to Venture on 17th. We acquired Venture on 17th several months ago. And when we bought the property, 20 of the 22 townhomes were currently occupied. One thing we quickly discovered was that the tenant base at the property was not a high quality tenant base. And several of the people living there immediately moved or stopped paying the rent. It was a surprise to John and I.
Yeah.
But we immediately, along with our third-party property manager, went into the property, started leasing up the vacant units and handling some of the issues that were at the property. We have also discovered that property does need additional attention. And our third-party property manager, who we've been working with for several years, couldn't quite do the job that we wanted to be done at that property. Even though they do a good job, the amount of work that they can do as a third-party person is not quite as high as we would like to see. And the old saying, the owner of the car always washes it the best. So we've decided to take property management in-house on Venture on 17th. This is something we've been looking at doing for several years, as we've had a third-party property manager managing our properties. But at this point, now is the time for us to bring this in-house to give our properties additional attention. And as I mentioned before, we've also started to see a little bit of a softness in the macro environment when it comes to leasing up our units and managing those units. By bringing management in-house, we will be able to give better service to our existing residents, and we'll also be able to do more when it comes to marketing and retention of those properties than a third-party property manager can.
And to cap that off, it's something we weren't prepared to do now, but it's something we were going to do. And based on the way the market's changed and the demands we're putting on our third-party property managers, we've decided that we can do a much better job right now, and we're doing it. The facts are, at the moment, we're running the properties better already, and it's just been a few weeks.
Yep. So we're pausing distributions on Venture on 17th temporarily. I hope it's only one quarter, but we're saying 1 or 2 quarters until we get in and restabilize that property. It's a beautiful property. The folks who live there really love living there, but a few things were needed before we can begin paying distributions again on that property. Let me move over to Venture on Mountain View. This is a property that's been cash flowing for over 2 years. It's in Sunny Slope, so it's in a little different area that has some challenges, and that property has always needed a little bit more attention. But as I mentioned before, we began seeing a softness in some of the leasing in this area, and we began seeing this at Venture on Mountain View a few months ago. So we have also decided to bring in the property management for Venture on Mountain View in-house. We've already began seeing some really good signs as we've done that over the last 2 or 3 weeks. We've already started to stabilize the property. We've been able to release some of these units, and the property just needed more attention than our third-party property manager was able to give it. So we are temporarily pausing distributions on Mountain View as well. We hope this is only for 1 quarter, might be 2 quarters. But it's a decision that we've made because we want to ensure that we have the reserves in place. We want to ensure that those properties are running well. And now we need to restabilize them. And as we do that, then we'll begin paying distributions again here in a quarter or 2.
Meantime, all the investors will continue to receive 12% return. It's just that we're not making distributions. So I want to be clear about that. And we have great properties. They operate well. And this is a good move for the company and good move for the investors on the properties.
Even though we have seen some softness in the macro environment, we have other properties that are performing really well. So these are the 2 that we've identified that we're bringing in-house right now. We've given them the attention that they've needed, and we've already began to see the fruits from those labors, and the properties are already performing better. So this is not necessarily a macro issue. It's really property specific when it comes to Mountain View and Venture on 17th. We have a great team at Neighborhood Ventures, and 2 folks who maybe many of you have had interaction with, Heather and Bella, who have worked on our investor relations team. We've asked them to move over into property management to help us in this transition. And they both had a great attitude and jumped it right into these properties. And we're really happy with what they're already doing on the properties. We've gone door to door, met all of the tenants of these properties, which was a great experience. I've done that myself. Yep. We were able to renew immediately in the first week 7 leases who were month to month and put them on a year lease. So some of this groundwork that a third-party property manager doesn't do, we as the owner have jumped in. And I personally am going to be supervising the property management side of our business because it's so important to what we do. And it's also been a lot of fun as we've jumped into it. So we expect to restart distributions on both of these properties early next year. We're excited to bring property management in-house. This is a good move for our company because it positions us really well, not only at these properties, but at all of our properties. We have more control, and we ensure that our residents are having a great experience. And remember, as an investor, you will continue to earn your 12% preferred return on these properties, even though we're pausing distributions currently.
Thank you, Jameson and John, for the updates. We're going to do a brief pause, and then we'll get right into the Q&A. All right, we're back. The first question I have on here is from a non-Arizona resident, so an out-of-state investor, which is pretty cool. What are the near future plans for the REIT? Are you guys planning on buying any properties soon?
Yeah, so I'll take that one. We acquired our first project for the REIT earlier this year, Venture on Williams. And, the REIT was our first offering that was available to accredited and non-accredited investors nationally. So it's been really fun to now have over 300 investors, many of whom are outside of Arizona. And the REIT's, it's pretty unique right now because it pays a distribution every month. And as investors in the REIT, that you receive 80% of the upside as the projects go up in value over time. And as I've talked to many investors, and I know Bart and John, you have as well, a lot of them love the idea that they get the upside over time and the cash flow as we go. There's also a lot of tax advantages in being an investor in the REIT. I'm not going to bore everyone with that today, but just to say, we're really excited that we have the REIT launched. Great things are to come. I don't think we'll acquire another project this year, but we do have some things in the works that will probably happen early next year for our next acquisitions. And as we've talked about with the REIT, we plan to acquire our projects that are performing the best, and the REIT can purchase those projects, liquidate the investors who are currently in it. Many of those who are in it can roll your proceeds into the REIT. And what that does is it gives us the advantage so we can buy, the REIT can acquire the best projects that we've already been running. And I think that strategy is going to bode really well going forward.
Cool.
Good.
The next question I have on here, it's from another out-of-state investor. It's, will pausing 17th affect the REIT's distributions?
Good question. Short answer is no, it won't. The primary holdings of the REIT is Venture on Williams, and then it has a small investment in Venture on 17th. So it won't impact pausing distributions on 17th will not impact the distributions for the REIT.
Sweet. Okay, another question we have on here, it's from Cam. It's, what, if anything, is to be sold in Q4 or the start of next year?
Well, to be very frank, again, the way the market is right now, it's probably not the best time to sell. Transactions are down significantly in the multifamily business, just like it is in the single family business. People are not motivated to buy or sell. So if we sold now, I don't think it's a good time to sell. So our plan is, if we get offers, we're always open to offers. We tell it to the brokers that work in our same building that we'll look at offers. But I think with the way interest rates are and the uncertainty in the market at the moment, I just don't think it bodes well for us. So this is what we've always said. We're a seller at certain periods based on our objectives, unless there's a change in the market. And right now we have got great equity and the properties are running fairly well, with the exception of a couple of them that we're getting back on track with our own management. So we're better off holding for a little bit longer.
I kind of liken it to the IPO market. There are some companies who are planning to go public this year, and they put those plans on hold, not because their business has changed or gone down. It's just the environment. It's a cyclical environment. Sometimes there's better times to go public and raise capital. In our case, there's better times to hold, and then there's times to sell. And right now we're in a hold pattern, and we're fortunate to be in that hold pattern because we want to sell the buildings when it's the right time to do it. And in the meantime, we'll operate them effectively.
This kind of goes with this. Do you guys anticipate bringing in property management for all your other projects?
We're starting with these first properties, and it's gone very well. I mentioned this already, but I've really enjoyed kind of getting my hands dirty on the property management side. It's fun to get to know the residents who are at these buildings. We have some great folks who live there, and we've outsourced that, and our property manager's done a great job over the years. We have an important partnership with them. It was just time for us to bring it in-house. So we'll take that kind of on a property by property basis. Right. We are still working with some outside property managers, and they're doing a good job on those properties. So we'll take that on a case by case basis.
That's the best answer. Yeah.
Okay. All right. So I see a handful of questions in here about distributions. So we've talked about quite a bit in the live stream. First one is, when do you expect to begin distributions for Route 66?
Frankly, we talked about starting distributions now because the property is performing really well today. The units are all completed. So we have 24 units up there that are operating as vacation rentals. The units are beautiful. We have a very effective team on the ground who's operating the property and working with the vacation rental guests. So we considered doing distributions now, but we haven't gone through a winter cycle. And one of the reasons why John and I decided to run this as a vacation rental is we know at Flagstaff, there's two seasons where tourists are busy up there throughout the summer, the spring and the fall. And then there's also a winter crowd for skiing. It's a little different than the summer crowd, but before we start doing distributions, we want to go through the winter season, see how that performs. And I think we'll get a lot of skiers, a lot of snowboarders are going up to Flagstaff.
Well, sledders, everything.
Yeah.
We don't have a lot of snow in Phoenix, so that's where you go. But yeah, the short answer is on that also. We want to get through the winter season, understand how that affects the property, and then build up a little bit of reserves because we just finished renovation, and then put the property into our short-term rental market. And that's probably the smartest thing for us to do. Get through that, and then we can feel very confident about distributions. But as Jameson said, property's doing really, really well. Our occupancy is strong. All 24 units are online, and we're just being strategic and smart about everything we're doing.
Nice. The next question is regarding to 12th place. When realistically should we expect cash distributions for 12th place?
We probably would have started that already. Our goal was to start that by now. So as I mentioned earlier, some of these, we did start to see a softness as we were leasing that up. And these last handful of units, they just didn't lease as fast as we wanted them to. And for a property to be stabilized is basically when we're fully occupied, which is, 95% occupied. So we need a few more months to get the remaining units occupied. And then that's in a position to start cash flowing and start doing distribution sometime next year, but we're just not quite there yet.
Yeah, we have this week 6 vacant units on the property.
Yep.
It's one of our best renovations, but we're again, our job is to be smart, make sure we've got reserves, make sure the properties we've addressed all the issues on the properties so that we can run it in perpetuity or through our investment horizon without any kind of other additional cash.
And distributions are great as an investor. It does, for us, we like to pay distributions out as well, because as that cash flow comes in, we actually have to, as part of our structure, all of the cash flow and the profits that come in have to go to investors first. So, but there is, as we started the last 3 months, as we kind of rounded out the leasing of that property, it just slowed down a bit. So we need to finish that off over the next month or two, and then we'll start doing distributions.
Yeah.
This one's directed directly to you, Jameson. It's, Jameson, what is the difference between reinvestments and auto invest?
So we have an auto invest feature on our new platform, and it's been really popular, especially with beginning investors. And we actually have a lot of more seasoned investors like it too, but I think it really is the beginning investors. On the 15th of every month, you can say, I want $100 or $200 to come out of my account and to purchase shares of NV REIT. So that's our auto invest option. And we have a lot of new investors who are coming in, and instead of investing $10,000 or $5,000 initially, they're saying, hey, I'll do $500 a month. And people wanted that option. So we built that option into the REIT. So that's our auto invest option. Our reinvest option is when you reinvest your distributions right into additional shares. And a lot of folks are doing that. We see requests every day, literally, hey, let's make sure that my distributions are reinvesting. And what happens when you do that is you're compounding your returns. So as those distributions come in, you can just have them sit there, or you could transfer them to your personal account and go on vacation. The best investors say, let me reinvest that, compound it. So that's the difference between reinvest and then an auto invest.
Okay, this is actually a John question. It's a cool comment as well. I'm glad you're making decisions based on the market and not because you feel pressured from others. With John's connections that you mentioned frequently, are you still finding deals?
Yes. First of all, thank you. We try our best. So we are seeing more and more opportunities being put in front of us. Every week we see a couple of things being put in front of us. The key concern that we have is our ability to finance a project. So the permanent financing right now is really dried up, or got to the point where it's not really effective financing. So we can buy a property that needs renovations. We can buy a property that's got some trouble, but to buy something and put longer term traditional financing on it is the issue. So again, you got to remember, even if we're buying a property and putting a construction loan on it, within the first year or two, we're putting a permanent loan on there. So we want to make sure we're smart about that, and that the properties that we're buying in this market and the cycle we're in can sustain a permanent loan, or we can put a permanent loan on there at some point based on today's current interest rates. So a little bit of a navigation issue right now, and trying to figure out what is the best thing to go after. But we're definitely seeing some people in the market having to sell because they have debt events or things happening. And we're looking at those properties pretty closely. So I think we're going to see not a windfall of properties like that, but certainly a fair number of them where people are going to make a decision to sell while they have equity in their assets on things that they can't continue to own. And that includes new construction projects, people that built things, developers who built things, smaller projects primarily, that finished it but aren't leasing them up because they're not moving quick enough on the lease up to be able to retire their construction loan, and we can step into it.
And the times like this, there are opportunities that come about that you don't get when interest rates are 3 and 4% and everyone's trying to buy. So
right.
John and I look at that all the time, and we're going to be opportunistic as these deals come across our desk. And to his point, we've looked at several. We passed on those because they weren't quite right, and the financing didn't make sense. But would love to buy great projects right now that somebody gets in a little bit of distress or they need to sell. We're happy to jump in there if we can make it make sense.
And not to belabor the point, but this is an important thing that we're doing. we need to acquire assets, and that's our basis. But with our fantastic management that we're building up, with our existing construction side, which has done a great job, and we can do things better than most. And then with our ability to in general to find the right projects. I mean, we really are building a fantastic team and system of acquiring and operating properties. And this really does bode well for all of us. So we can effectively buy properties that most people might struggle with down the road at a better price and move quicker. And I think that's another one of our magic, our secret sauces, our magic to our acquisitions.
When we started this, it was just me and John. We were doing all of it ourselves. Then we were outsourcing a lot of things. We were outsourcing our production that we're doing now,
our crowdfunding software,
our software,
everything.
We were outsourcing the construction. And we've slowly learned one bit at a time. We've brought it in-house, and every time we've done that has been a good decision. And
I agree. Yeah.
And those are big assets the company has. To John's point, I love the fact that we have a great construction crew that's part of the company. They jump into our projects and do things that because they believe in it. And when you're working with just an outside contractor, you don't have that ability that you do bringing it in-house. And it's the same we're seeing with property management. So it's kind of that end-to-end vertically integrated strategy, and it's worked really well for us and positions us well going forward.
Cool. This is a nice comment from Lori. Thank you for being wise and patient on these investments. Lori, thank you for understanding. We appreciate it.
Yeah.
One
of the questions on here is, do you still plan on doing build-up projects in the future?
Build up, which means new construction. Yes. But at the moment, the one part of financing that fell apart the fastest, construction financing, is entirely gone from our market. Unless you are a national builder building a institutional quality property. What's the saying? If you put $20 million in our bank, we'll lend you $5 million.
Right.
So the short answer again on that one is we'd love that, but I think we can probably find deals the way the market is right now over the next few quarters here, of projects that someone did all the heavy lifting on, get the entitlements in place, built the project, and now have for example, a construction loan coming due, and they weren't prepared to lease up, or they thought they'd lease up quicker, so they can't retire that construction loan. We could step in with some sort of permanent financing on our side, and that might be on the REIT because it's a stabilized newer project, or it might be on the crowdfunding side, depending on the project and how we have to manage that process. So we've looked at, probably 3 or 4 of those in the last few months, and one of them is still on our radar screen. We're just trying to figure out how to, basically how we're going to finance it is the issue.
I think ultimately we will at some point build up. I know John has an itch to do that. When you renovate buildings, it's nice because it takes some of that early work out of it, the rezoning, but then there's also, until you start opening up the walls and doing the renovation, you don't really know what you have there.
It's always easier to build,
and
except for the risk involved in building, right?
Right.
Yeah.
And so I think at some point we will do that, but it's a matter of it being at the right time.
Yeah.
But I look forward to that day. I would love to have a brand new venture residences project that we
our style,
kind of build our look.
Yeah, our style, the floor plans we want, the amenities we want to have, and we'll be very good at building what I consider to be middle market projects. So, 10 to 80 unit projects. That's probably going to be our bread and butter when we start doing that.
Awesome. There's only 2 more questions, but with Bella and Heather in property management, who is in investor relations now? I can answer that. I am. If you guys need anything, feel free to reach out to me. Amanda Schwick's also amazing. She's here to help you. Any questions regarding investment opportunities, the platform, you name it, feel free to reach out to us, Bart at neighborhood.ventures, or Amanda at neighborhood.ventures.
Yeah. And that was part of what's happened this year is we've really built a strong team, and it gave us the ability to jump into the property management quickly. And, we haven't missed a beat. And I just want to give credit to our entire team, including Bart, working late all week, getting this all together. Our content team, Oakley, Amanda, we have an exceptional team that makes this all happen. So, and to serve the investors. So we want to do this to answer hopefully as many questions as we can, but we're always here for follow-ups.
Absolutely. Yeah.
Another question that just came in is, are you concerned about the stability of the banks you are working on or working with
currently?
Yeah.
Not really. I think, we've got good loans on the properties we have stability. We have stabilized loans on. Are we concerned about the banks we keep our cash in? No, we vetted that pretty well also. We made it even the property management stuff. We kind of made a decision based on location, strength of the bank, and their customer service for our size of a company. And no, I'm not concerned about that at all right now. 4 or 5 months ago, when we saw things falling apart, I think we all questioned every bank we work with.
Yeah, and we were talking a lot about that and looking at
every day.
Yeah. But we do have strong lenders who are in place, and they we have several properties that have great low interest financing on them, and that's part of why we don't want to sell these properties now. They're cash flowing, and we have that stability.
Yeah, their assumable loans would have been great.
Yeah,
which almost doesn't exist in our market at all, or hasn't. So
yeah.
We have another question that just came in on Ventron Country Club. What are the contingency plans if the city does not approve the request?
That's a good question. We always try to have an A, B, and C plan. I won't go into the weeds on it, but we heard more good news today on how that project's going. I'll just tell you that we're very confident that we're going to be in that. We're heading towards the point where we're going to get approvals, and sooner than later. If it doesn't happen, our backup contingency plan is potentially to put a hospitality loan on it and run it in perpetuity as a hotel again. But I'd rather not do that. But that possibility exists, and it still confirms our value in the project and our equity. It's just that we're not hotel operators, even though we apparently are pretty good at it.
We have been for a couple of years. We have become that. And I think that would even be potentially another short-term solution, because we would probably come back and take another bite of the apple with the city later. When we purchased this property, the environment is the same as it is now, there's a shortage of housing, especially workforce housing, affordable housing. And that's why there's so much support from the city council and the mayor's office to get more of these types of units available as apartments. There's not a real shortage of Airbnbs, as we know, or short-term vacation rentals. So all of these units have kitchens. They work really well as homes, as apartment units for folks who live there. So even if we had to do that for a period of time, I think we'd probably come back around and try to rezone it with the new administration, right? So John talks about ABC plan. We're already operating and cash flowing as a vacation rental, and we can do that. But ultimately, best use of the property is as an apartment building.
Yeah, and I want to make sure I underline one thing here. The reason why the conversion to apartment buildings is so important to us is it's the cost of debt. So as I talked about banks not being available, at that size of an asset, we have Fannie Mae, Freddie Mac, and HUD as available lenders. They've always been in the market. They're strong lenders. They're much more affordable loan rates. They're, let's call them high sixes, low sevens, probably more in the high sixes right now. So by replacing the current construction loan on that property with a permanent apartment loan on the property, it completely changes the dynamics and creates a tremendous amount of cash flow on that property.
Yeah.
That's why it's still our A plan. And I'm more confident than ever today that that's going to be affected. We've got good stuff going on that.
All right, it's the last question we have. But if you guys have any other questions and you don't want to type it in here, feel free to send a question or an email to info@neighborhood.ventures or directly to me, Bart@neighborhood.ventures. But the last question is, when will you do an open house for 36th?
Oh, yeah, that's coming soon, actually.
Yeah. So, all right. So we
were talking about that.
So we turned to our first 10 units. We've got a handful of the units, approximately 5 units or so in transition where the residents' leases are expiring, and we're going to be renovating those. The issue that we're dealing with on that property is we have to honor the leases from existing residents that are there. And we have some leases that expire in December and some leases that go into 2024. So we're probably going to end up, we're working with the residents right now to transfer some to the renovated units, working with residents that might want to get out of their leases early. And so we can figure out how many we're going to have renovated. So it might be one of the projects that we pause our construction on while we are working on our next things we're going to be doing. And then coming back to those units and probably have an open house with 3/4 of the units renovated. Yep. And, we just have to be responsible and fair to the residents that are in there and the terms of leases that they had when we assumed the property.
I will say the units are looking awesome. As John said, we have 10 units that we're starting to pre-lease. If you haven't yet watched the recent renovation update that the team did a few weeks ago, you can really see the transformation. And we're excited to get these units leased up. And it really looks, it went from kind of this drab property that's in a good location without any personality to it to some nice colors, nice textiles. I think it's going to be a place a lot of people are going to love to live.
And we've confirmed our rents. The rents in the neighborhood are easily $13.50. So yeah. Anyway, we'll let you know about the open house. We just like to have it when we know we have a good portion of the property finished, so we can get everybody through things and be fair about it.
We talked about it that probably early next year. The holiday event in December. One thing I want to mention with the holiday event, if you haven't come to one before, this is where you're going to get your custom Neighborhood Ventures bottle of wine. This is a blend. I am not a wine connoisseur, but this is a blend that's created just for Neighborhood Ventures investors by Carlson Creek, which is a vineyard in Wilcox, Arizona. And they blend this just for our investors. This is kind of what we do every year as a thank you to you. We're pretty frugal guys. Trust me, this guy's frugal. And so am I. But once a year, we want to just say thank you. And we have, this is our 2023 bottle of wine to hand you. And we do one every year. So you might have yours from last year, unless you already drank it. That's okay. But you got to come to the event to get your wine. So we want you to show up. Last year we had over 100 folks here at our property. It was a great night. And so I'd really encourage you to come to that. It's December 1st. It's a Friday night, about 6:30, I think is when we'll do it. Come pop in, get your bottle of wine, say hello. We'd love to see you.
Good. Well, thank you, everybody. We really appreciate your support, your patience, and we're all here to help out. And I love what we're doing as a team.
Thank you.
Thank you.